Here we go, live at 5 for our great happy hour, the ETF Think Tank Happy Hour. And we're thrilled to have Jamie Coutts all the way from Sydney as our guest speaker. I'm Dan Weiskopf, lead ETF strategist for the ETF Think Tank and co-portfolio manager of Block, as well as member of the investment team at Title Financial Group. So as we bring in everybody, give us a couple of minutes, more seconds, as we introduce ourselves, and then we'll get started. And we're talking about fundamentals behind crypto. Really exciting show. Thank you. So I'm gonna punt it over to who wants to raise their hand. Okay, Cynthia, you raised your hand.
Hi, everybody. It's Cynthia Murphy, head of research for the ETF Think Tank. Thanks for joining us. We have a great show today. We always forget, lately anyway, to say what's our drinking word. So I'm going to say, because I'm thinking about it, it's valuation today. So anytime Jamie says valuation, take a swig. And we will have a great show. David, you next.
Thanks so much. David Chikansky here, fellow portfolio manager of the Title Financial Group. Very excited to dive into Jamie's formula, and I will kick it off to our founder, Mike Venuto.
Hey guys, Mike Venuto, co-founder, chief cat herder. Excited to be here. Unfortunately, I have to drop off a little early today, so when I disappear, don't cry for me. I'm going to talk to a client, and you guys get to sit here and talk all kinds of amazing things about Bitcoin. We're going to introduce Jamie here. He's been building a valuation model for Bitcoin. It's pretty amazing stuff, and I'm really excited to hear it and the process and everything behind it. Yes, valuation is our word, and it's not a surprise that Bitcoin is something that this particular ETF think tank cares a lot about, because we are behind the blockchain ETF Block. We're behind the inflation fighting ETF IWIN, which has exposure to Bitcoin futures. And we're partnered with HashDex on the DeFi ETF, which is the only 33 Act futures ETF out there that owns Bitcoin exposure. And we've got some big plans for that in the future that we've telegraphed to all of you a couple times. I know we've got some disbelievers here. We've got some believers. We've got some skeptics. But I don't think any of us really know how to map this thing out. So with that, let me introduce Jamie. Or Jamie, tell us a little bit about yourself, and then we'll get right into everything.
Yeah, thanks very much. I really appreciate the invitation to be here, guys. I know I'm not the first Bloomberg analyst, but I'm privileged to be here and be able to talk about the thing that I love most, which is crypto. A little bit about myself. I started off in Australia, as you can probably tell from my accent. I am Australian. I'm based in Australia again, but I spent about 20 years overseas. So a little bit of time in London on the sell side. Primarily sort of trading equity markets on a night desk, and then moving out to Singapore just before the GFC. And that sort of took me through to a couple of different roles on the sell side, leading into a buy side execution role with Tudor Capital Management when they had some long short funds out in Asia. And then after that, when that was shut down, it was basically onto Bloomberg and an equity specialist. And whilst as a Bloomberg is when really crypto came on the scene. And while I was there, I sort of got my hands dirty a little bit. Bloomberg didn't have a lot of product at the time. We're talking about 2015, 16. I started to look at the space for a couple of different reasons, but in 2018, started to really bang the table during the bear market to product and sales that we needed to get involved in the space. We had a little bit of pricing on the terminal, as some of you may remember. But we didn't have any other products, so to speak. So I wrote a report internally, which was a pretty comprehensive one, and it went all the way out to senior management. From there, they sort of put me in charge of being the Asia Pac crypto strategy person, I guess. It was an unofficial role because we didn't have any product, but they were exploring. And so from there, we sort of launched into a couple of different areas. And I moved over to the Bloomberg Intelligence team, where I am today, to become the crypto market specialist. And I understand that Mike McGlone, who's our commodity specialist, has been covering Bitcoin for some time. And we have a team of other Bloomberg Intelligence analysts that sort of cover the space tangentially or directly. In the case of like James Seyfert, who's our ETF analyst, and Eric, who's the senior ETF analyst, they've actually got a lot to do with the space because of what's happening, obviously, with BlackRock. But this has been sort of a trend or an issue in the space for many years, as you know, the failure to get an ETF off the ground in the US. But really, my approach is, and how I sort of pitched to the Bloomberg Intelligence team why they needed to at least hire someone, and they didn't have to hire me. But the problem I saw outside looking in was that no one was approaching the space in a sort of a constructive way that would help traditional investors really understand the space a bit better, or move into the space, or take them on a journey which either they can come to their own conclusion at the end and say, this is just not the asset I want exposure to, or perhaps now it makes a little bit more sense, and given where it's going, maybe I need some exposure. So, the irony that I was explaining to Dan before the call started was that I'm not a financial analyst per se. Whilst I was sort of grounded in the school of fundamentals as an equity sell-side person, I actually cut my teeth really on a lot of trading desks using technical analysis. And I have a CMT, like a Chartered Market Technicians accreditation, and a CFTE one as well. And I've been very much versed in that sort of industry. But really, everyone can trade momentum, everyone can trade price signals. What was really needed to bring in the trillion-dollar asset managers was a fundamental anchoring for the asset. And so I just tried to think about, what were the things that drive network or network value, which is going back to Metcalfe's law, and seeing how that applied in the case of Bitcoin and these crypto assets. And I've just sort of looked at the on-chain data and worked with a couple of different data sets to try and build something which hopefully illuminates, I guess, really, what are the key drivers for the asset's performance.
I'll start off, Jamie, with putting things into a bit of context. Now, in the chat, people will see a deck, right? And one of the diagrams that you have in there, I think, puts everything into context. The Dow theory dates 1890 to 1930, right? Now, things have changed a lot over that period of time. Fundamental analysis in 34, technical analysis 48, et cetera, right? And then we go all the way to modern portfolio theory, behavioral finance, factor investing, and network value. That's the methodology that you're driving, right? Why is it that some of those other methodologies really just aren't appropriate and they don't work for Bitcoin or crypto? We'll talk about crypto in general.
Oh, you've got the slide up here. Great. Yeah. So I'm a bit of a historian. So I love markets and I love history. So putting this together was really fascinating for me, because as I was sort of trying to develop my thesis, I really wanted to look at what potentially could work for this asset class. I wouldn't necessarily say that these other techniques don't work. I actually use a really multidisciplinary type of an approach to the asset class. So I draw from other investment modalities or methodologies, very much technical analysis, because this is a momentum-based asset class. So technical analysis is definitely part of the process, but it sort of comes in a little bit later, because you want to have that sort of fundamental basis. So there is fundamental analysis, obviously, in what I do, but it's just not the fundamental analysis that people might be familiar with. So that's where the Metcalfe's law network value approach really applies, because it's kind of, I somewhat see it like it's the fundamentals for networks. It's the fundamentals for crypto. Yeah, at the core, really what we're saying is that the value of a network is proportionate to the number of users or the nodes on the network, and you can sub nodes with people or other variations. So you need to look at data points which represent the activity on the network, the number of nodes on the network, so to speak, and then sort of draw from that what kind of price signal it generates. And that led me, and so, quantitative analysis is very much part of this as well, because you need to sort of understand, if you're looking at a data point, does it have any signal? You can do simple regressions, you can do multivariate regressions, Always with those, those kinds of relationships, they break down from time to time, right? Relationships are not static. They are dynamic. So you need to be aware of that, but it gives you a basis for understanding, okay, if the network is growing, if these 2 metrics out of these 5 are growing faster than everything else, then in the past, what this has meant for price is that it's either, moved higher or moved lower. So that's kind of where I've got to. And I think it's a process of drawing from all those other disciplines that have come before to try and come up something a little bit more customized for this asset class.
So I want to jump in because I love the concept of a power law being applied here, because it's something I've used back when I had hedge funds. We did this all the time. We used Zipf's law, Pareto distributions, Benford's law, like applying them to things that are hard to value or hard to map out. Could you just describe Metcalfe's law a little bit better for people? What a power law is and what Metcalfe specifically? Because I mean, the simple version, it sounds like it's kind of like a Lindy, right? The longer it's around, the longer it's going to stay around. But I know it's way more complicated than that.
Well, I mean, my understanding of it, it's pretty basic. So I've just looked at the core thesis for Metcalfe's law when it was applied to computer systems and telecommunication systems in the 80s and in the 90s. And from that, they were able to derive that the value of the network was proportionate to the number of users, nodes on the network. So the number of those nodes or users and the interconnections between those users increases the network value. So some of it's, when it comes to Bitcoin, you can't quantify all of that. Because when you start looking or seeing the developments in layer 2s, a lot of the interconnections are obfuscated away. So you don't have raw metrics. But at the base layer, at the layer 1, the Bitcoin network itself, you can extract data points which give you insight into the number of nodes or the number of users on the network. So that's how I've kind of looked at it. But you have to triangulate, some of those metrics with other things as well. And macro plays, and we haven't really talked about the macro side of it yet, but I mean, that's kind of my starting point, because there was a macro thesis or a social thesis at the core of what Satoshi did from the very start, and most likely at the core of a lot of the other protocols that have come since. They're trying to solve something that is fundamentally, in their eyes, broken with the system or society. So, yeah. We're even talk about the macro and the thematic side.
No, I think that's important because, look, we all saw the news the other day that the SEC, the statement, I don't know if it's real or not, but that the SEC asked Coinbase to delist everything but Bitcoin. That whole macro component of Satoshi, like giving this to the world and then disappearing, is pretty amazing, because it makes it hard for anybody to go after him. You can't put Satoshi in jail, right? And we don't know if Satoshi's a man, a woman, 10 people. We don't know any of that. And we hopefully never will, because I think it would be damaging to the project. So what, we get it. This is the starting point. Just because I know I got to leave in a few minutes, I'm going to get my question in and get out of the way. Which slide do we go to first to start to understand where you see it from a valuation standpoint today?
Yeah, well, if you scroll through those slides, maybe Dan, are you in control of them or Cynthia?
Yeah. Benuto is.
I am at the moment. Where do I go?
Okay, so we're going all the way through the macro stuff. Actually, if you go back, let's go back to the slide, which I think shows the various elements. So if you go back up, yeah, there hopefully is a visual. And keep going.
Oh.
No, it's macro. So there's, yeah, okay, so this one here, network adoption. Okay, so really, we start from the fact that we've got these secular trends in place. Excuse me. technological adoption, ongoing debasement, government centralization. So there you've got the actual secular drivers for this ecosystem, this asset class, whatever you might want to call it. And then really the big driver is looking at, what's happening with essentially interest rates, the price of money, and the quantity of money in the system. If you have those factors working in your favor, then you should see demand follow. So, I mean, I could have just really started with the on-chain data and said, right, looking at the data, but I needed to take a step back and understand what was driving that. And so when I see divergences between perhaps what's happening with the macro setup and what's happening on chain, that's a signal in and of itself. So the next part is really like the utility, that what is this asset, what is this network delivering to people, what is its use case, its purpose, is it providing utility or value to people? And then the last factor is looking at the supply fundamentals. So critical, as everyone here would appreciate, is that you can have a great idea and a great utility for a token, but you will destroy the utility of that token if you do not have your tokenomics balanced correctly, if you do not have the distribution or the supply of that token measured in a way that you're not destroying the value of that token, which will end up driving the utility down because no one wants to use that token for whatever purpose if they are being debased. That's the reason why some of us are in crypto, because our fiat is being debased. And the same, you see the same shenanigans in the crypto space as well, which shouldn't be that surprising, I guess.
So do you want to move to another slide to explain your process?
Yeah, sure. Like, why don't we just skip through to the macro stuff? And I had that slide up, which is that one before, Dan. I just look for the right environment for crypto to perform well. And I came into the role in January of 2022, and really the first note I published was bearish crypto for the next 9 months, because my thesis was that that's about as long as they would be able to maintain extreme tight liquidity or tight conditions in monetary policy. And I'd been using the Fed balance sheet as my go-to chart for the Bitcoin cycle since 2016. It's been upgraded and modified thanks to the work of some very good analysts out in the marketplace, and a shout out to Darius Dale at 42 Macro, and Arthur Hayes for all the work, and also I should mention the guys over at Cross Border Capital. Their work on liquidity analysis has been very informative, and it's really upgraded my understanding, because just relying on the Fed balance sheet was a fairly narrow way to think about liquidity. But essentially, that thesis in 2022 played out really well, thankfully. And then, it basically bottomed out. Now, conditions are still tight, right? We still have higher for longer rates. Inflation hasn't come down completely. We haven't seen the pivot. But if you look at the momentum of the tightening, that basically peaked in fourth quarter of 2022. So Bitcoin essentially responds to the momentum of liquidity. We do not need to have necessarily a pivot from central banks. We just needed them to slow down. And in the Q4 was when BOJ, Bank of England, basically hit the limits of what they were trying to do, and had some issues, to put it lightly, in their domestic markets, whether it's with the pension funds in the UK, or the JGBs in Japan, which they've discovered again 6 months later, and not really learning from their lessons. And that created the setup for crypto to essentially bottom, to Bitcoin, for essentially Bitcoin to bottom, because the other assets in the space have got, idiosyncratic risks that Bitcoin doesn't. So that's really the macro thesis. Now, Dan, I can show you the dashboard that I've got for Bitcoin, if that's helpful, so we can go through it, because this is really where the fundamentals come into play.
Sure. You should.
I keep thinking the words fundamentals, but it's valuation. I feel like we should have went with fundamentals now. So
We can have two words. We can have two words. You're not. Anyway, you've got to go. So, he's got the screen now.
yeah.
So I needed to update some of the data, but this will give you a better sense of what I'm talking about. The Bitcoin fundamentals dashboard uses about 40 to 45 different metrics, I believe. Not just fundamentals, not just on-chain data, but there is some exchange data as well. So looking at the derivatives market, because the derivatives market is multiples more than the spot market for Bitcoin. And I think that has a pretty big impact on sentiment and price. But if we look here on the dashboard, the way I've configured it, if I can just, okay, so we're looking at data as of the 30th. Okay, and I'm just going to scroll down a little bit. So I've got this section here called network adoption. And can you guys see that clearly on your side? Do I need to on? Okay. All right. So the way I sort of configured it was that, what's important from a network, from a network value or a Metcalfe's law perspective. We talk about nodes, we talk about users. In on-chain data, that's addresses or entities. This is mostly Glassnode data that I'm using for my Bitcoin dashboard. So I'm looking at the number of entities on the exchange, and then I sort of break it down in terms of like, what is Bitcoin's monetary properties? There's obviously tree, there's a medium of exchange, store of value, and unit of account. So I've got medium of exchange and store of value categorized, and the metrics that apply to that underneath. And so from just this one part of the dashboard, I can get a pretty good sense what's happening on the base layer, on the L1 for Bitcoin. And if we look at the current setup, what we have is active addresses at about 941,000. That's daily active addresses. Active entities isn't showing because the data feed hasn't come through, but it's roughly around 275,000 entities. So an active address, several active addresses may belong to the same entity. So Glassnode uses a little bit of logic and machine learning just to sort of cluster those addresses. And active entities is a very strong signal for Bitcoin. Regressed against the price over sort of 13 years on a monthly basis, looking at percentage change, it's got about a 0.55 R squared. Right, so about 55% of the price of Bitcoin is explained by the change in the number of active entities on the network. And actually the relationship has been pretty stable. So I lean on that quite a lot in my model. Now, the problem with active entities is that it's been sideways for 2 years. It has not gone, really that 300,000 level on active entities has been like a technical resistance level, to use a term. And for a bull market in Bitcoin, I'm looking for a breakout in active entities above 300,000. Then the medium of exchange, you can see here that the volume and the value that's moving on the Bitcoin network is still quite depressed. And if you scan across to the right-hand side, I've put everything in terms of like 3-year and 5-year percentiles. And a lot of these metrics are in the bottom quartile. So so there is less value moving across the network. And when you consider that Bitcoin is up 27% in the last 12 months, and some of these metrics are down 45, 80, 80%, it's actually underperforming the price because the value metrics are priced in USD, right? So there's just less activity moving on the L1. And that's less of a price driver, right? It seems to be more of a coincident sort of driver. It'll pick up as the price picks up, but it's just worthwhile knowing that the Bitcoin network in terms of the dollar value that's moving across the network every day is actually really low compared to the last 5 years. Even after you strip out the fact that price is down 50% from the all-time high.
Is
Okay,
there, so do you think that's caused by both the decrease in platforms that people can use, or is that a very novice question in response to that? Right, like FTX, all of these other platforms, people used to have, I think, multiple platforms, and does the consolidation slow that down?
I think the impact of FTX is definitely affected things. When they left the network, there was a lot of activity that went with them. So in terms of the number of active entities, that really didn't change much. But when you had a large player like FTX move off the exchange, that had an impact on how much value was probably that is transferring across the chain. But yeah, there's also some other factors that have come into play this year specifically, which was the creation of NFTs on Bitcoin. So I track something called the median transfer value, and it's at all-time lows. So the activity that's moving across the network now is of lower value, and I think a lot of that is being driven by sort of the NFT ordinals activity. So yeah, there's some things that I just can't quantify from this. Some of it may have moved to L2, but L2 transactions are generally pretty small in nature. You're not using L2, like you're not using Lightning to move $1 billion. You'll use the L1 for the security of the L1. So yeah, there's just less usage of the monetary network of Bitcoin than it has in the past.
So Jamie, is there a way for you using this data to say that Bitcoin is 20% undervalued, or a specific number?
Okay, so the way I've looked at valuation, and I've just updated the data here, so I've pulled it back a couple of days so you can actually see things like active entities, and it's now updated to 272,000. So yeah, Dan, to answer the question, before I move on to just the valuation aspect, I just want to draw people's attention to the other set of metrics, the store of value metrics, because they are in complete contrast to the situation or the picture that I was painting with the median of exchange metrics. So activities down, activities depressed, value moving across the network. Think of it like Visa. People are just not transacting as much, right? So they're not clipping as much in terms of fees for the miners. But from Bitcoin's perspective, you know, the store of value metrics such as the number of non-zero balance addresses, all-time high, the number of addresses with at least one Bitcoin is at an all-time high. Accumulation addresses, all-time high. The percentage of long-term holders, people who have held their Bitcoin for more than 6 months, all-time high. So there's this real dichotomy on the network where people are hodling, they're accumulating, but they're just not moving as much value across the network as they were 2, 3, 4, 5 years ago.
That makes sense. Basically, since like the banking crisis or the almost banking crisis this year, it's correlated a lot higher to gold than it has like growth stocks. That probably has something to do with that too. Interesting.
Yeah, we saw and David, yeah, it's a good point. What I saw, what happened in March was the tick up during that crisis was a real signal for me because, you know, every other time where.
But that tick up was seen through store of value then. Is that correct?
We actually saw the median of exchange metrics also tick up as well. So that was really instructive. It was the first time in Bitcoin's history where the interbank borrowing rate spiked above 60 basis points and Bitcoin didn't shit the bed. It was up for the first time. There's been 5 instances, I believe, since 2012. First one being the European debt crisis, interbank borrowing rates. I think, you know, it used to be the old TED spread. It's now the forward rate 3 month or something. Basically the rate that the banks lend to one another. above 60 basis points, everything, risk assets sell off big time. It got there this year and Bitcoin rallied. So it was, that was really instructive. But yeah, there was more activity. So people were using the chain, and we can speculate as to whether that was people moving money out of the bank and using the Bitcoin network, or people just speculating that this would be a beneficiary from the banking crisis. We don't know. Right, Dan, the question was really about valuation. How do I think about valuation? So what I've done is I've created a couple of ratios. So looking at ratios that are, or metrics that are pretty well established already in the marketplace. So most people who follow Bitcoin are familiar with the NVT and the MVRV. So let me break that down. NVT is network value to transactions. So looking at the market cap divided by some normalized measure of the transaction value, and which we spoke about that just previously, like medium of exchange metrics like the transaction values essentially are really depressed. So my NVT premium metric is trading, and you can see by the color being red, it's expensive. The market value relative to the transaction values on the network based on this one metric says that Bitcoin's overvalued. If we look at the MVRV, which is the market value, the market cap, divided by the realized value, which is a specific crypto term, which instead of measuring the price times by the circulating supply, you look at the last time coins were moved in aggregate times by the circulating supply, and then you develop a Z-score, so a normal distribution for the entire history of Bitcoin to see whether it's trading in an expensive or a cheap range. And it's around the middle. 6 months ago, 9 months ago, it was very cheap. It was trading 2 standard deviations below the mean, and now it's trading roughly around the mean. And this makes sense to me because of where we are in the cycle. We've got these 4-year cycles. We've got the Bitcoin halving next year. This is roughly where Bitcoin is at this point in the cycle based on the previous cycles. And that's just purely a price valuation tool. It's not looking at transactions. The next metric is the price to active entity Z-score, and it's around the middle as well. It's about 1 standard deviation. And so it's fairly priced. I use another one called the price to Bitcoiners, or the price to hodlers metric. It's about the same. It's not expensive. It's sort of around the midpoint. Another metric, which is not mine, which I've has been used for about 5 or 6 years by a guy called David Pure. He's now at ARK as a Bitcoin analyst. He created a metric looking at miner revenues or fees on the network. And it's been an extremely good timing signal. And it is also in the sort of moderate price range, or sorry, moderate valuation range. So on transactions, Bitcoin's looking expensive. But on most of the other metrics, it's like moderate. It's not cheap. That the days of Bitcoin being cheap were in the fourth quarter of last year, first quarter of this year. We've moved out of that level. So yeah, that's kind of a summation of like the fundamental valuation metrics.
Are these 12-month change percentages for real? I mean, those are like huge numbers on this valuation bucket.
Yeah, that they are, but I wouldn't necessarily look too much at the percentage change of the valuation metrics per se. But yeah, they are. So you can look at, NVT price at 1 point of basically 45% above 145% above the indicated valuation is putting it at the 91st percentile of the last 5 years. So, excuse me, 12 months ago, it was, very expensive. Then it became very cheap, and now it's expensive again. During the second quarter of last year, there was a huge spike in medium of exchange transactions. There was a lot of activity on chain, and that was probably Terra Luna. And, we were just, we were in that sort of stage of the bear market where there was a lot of liquidation. So a lot of people were probably forced selling. That spiked a lot of the metrics in medium of exchange. And so that's why I don't really fall back on it as like a key part of my valuation approach, because, that was indicative of liquidations in the market and stress. And if you traded on that thing, oh, well, there's a lot of activity on the Bitcoin network right now, you were missing the point. That was because people were dumping, and that was cascading into more selling. And so that's why I sort of try to use a combination of different metrics.
So how do you account for the price sensitivity with big spikes at different times in your data set? Because, it moves what seems to be often in an irrational way based on news flow or excitement, right? Do you have any metrics to adjust for short-term volatility in Bitcoin?
The answer is no, because I try to think about things in a bigger picture, or from a longer term perspective. And when I did that, which the job really forced me to do, so I wasn't trading it anymore, and sort of had to think about it sort of from that sort of cycle perspective, like where are we in the cycle, and what typically plays out in the cycle. It's allowed me to sort of zoom out and miss a lot of that daily volatility and noise. So I work with a lot of weekly charts, and I think it's really helpful to work with the weekly charts or the longer time frames. I mean, when I was trading it, I was looking at the 240-minute chart. But that doesn't really, I think for asset allocation, that's not going to be all that helpful because there is so much noise, Dan, as you said. So not so much. And one way to also look at it too is just to take the Bitcoin price and divide it by the volatility. And then when you're looking at other assets, do the same and have a look at what you see in terms of like the risk adjusted or the volatility adjusted movements of this asset versus other assets. At the end of Q1 or start of Q2, I did a bunch of reports around asset allocation for Bitcoin. And what I found was really interesting is that during the 2022 bear market, as bad as it was, on a risk adjusted basis versus a bunch of global assets, including, obviously bonds and commodities, but equities broken down into emerging markets, US, global, and social media companies and various other things. Bitcoin for the first time was actually in the middle of the table in terms of risk adjusted returns. What happened previously in previous bear markets, Bitcoin was at the bottom. So Bitcoin has actually, its volatility has declined slightly. But what it tells me is that the rest of the world, all the other asset classes, are becoming more volatile. And I think for me, that's telling me the system is more fragile. Other asset classes that were seen as safe havens are starting to lose that edge. I'm calling out you fixed income. And Bitcoin may actually be as volatile for the next 10 years as it was for the last 10 years, but relative to everything else, it will look more attractive on that volatility lens alone. So that was kind of, that was a bit of an eye opener.
But Bitcoin did have more risk adjusted downside than equities. It's just that like fixed income just kind of blew it all out of the park. Is that correct?
Yeah. And look, I mean, I should have qualified. There's, I look at things maybe slightly different to the traditional portfolio manager. I don't believe Sharpe ratio is the best measure. I believe Sortino ratio is, because you're not being penalized for upside volatility. But yeah. But
I think that's important. I think that's important, right? Because there's nothing more frustrating I think for driving alpha, getting a big return, and then people saying, wait, you've outperformed, you've provided a great return, but we're going to penalize you because you're too volatile. You can't have both. You just can't. Right? That's been my experience.
It's always baffled me. It really has. I don't know why, but it's a convention, and people stick to it.
So just in case people don't know, Venuta was on before, and he's a great fisherman. Talk to us a little bit about crabs, tunas, and whales. Just from a bottoms up perspective, so people have a context of that.
So I think the terminology is from Glassnode. So they've sort of categorized the type of participant on the Bitcoin network based on how much Bitcoin they own. And obviously the whales are the large players that have an outsized effect on the price of Bitcoin. And then most of us are in the smaller fish category. But what it's saying is that if you look at the right-hand side and the 3-year and 5-year percentiles, if I showed you this on a chart, the guppies, the crabs, guppies are those that have 0.1 to 1 Bitcoin in their wallet. Crabs have 1 to 10, and tuna have 10 to 100. Those cohorts are actually either at all-time highs or near all-time highs, but the larger cohorts, these sharks, dolphins, whales, which own anything above 100 Bitcoin, are lower than something like 60 to sort of 82%. But the interesting cohort is the dolphins, the 1,000 to 10,000. They own about 4.6 million Bitcoin, so about 25% of the total supply. But in terms of their level of holding, they're roughly around the first quartile. They're around 21% of the 5-year range. They've actually been liquidating or selling over the past couple of years. And this metric really ticked down last year, because a lot of the exchanges were in this cohort, this category of about 1,000 to 10,000. So the FTX was in that cohort, or at least some of their wallets were. So as they liquidated, that cohort basically sold. That obviously had an outsized impact on price, and just the plebs were out there accumulating in the face of everything that was going on and just sucking up more and more Bitcoin into their wallets. And now they control roughly about sort of 15% of the network supply. And these are people that are looking at Bitcoin as a superior savings technology, maybe less inclined to sell. Everyone will be inclined to sell at a certain price, or some at a certain price, but these are this is the sort of migration of coins into smaller, more distributed hands, but also those with higher conviction than exchanges or even some of the sort of fast money hedge fund type accounts.
I guess there isn't a fish or a swimming mammal that's bigger than a whale, right? So it's funny because you think about a Michael Saylor, he's clearly a whale, right? With 155,000 plus Bitcoin, and you look at the context of the potential of an ETF as well, and it actually skews the category to such a large degree. And what people, I think, often forget is, who owns what. Well, not necessarily the individual, but you can track exactly where the Bitcoin is. And that's how you know this information.
It's extraordinary when you talk to portfolio managers, and I don't want to underplay all the issues that are in the space, because there are. But I'm a believer in the technology long term, and a lot of this will get sorted out, and a lot of the fraud, for lack of a better word, but some of the shenanigans that have taken place in we're not referring to Bitcoin here, but I'm talking more in the the proof of stake will get sorted out. But the amazing thing is how you can get real-time data on the profitability or the cash flows of these protocols. So, are we all, as an equity manager in 2023, aren't we a little bit tired of the fact that we have to wait for quarterlies and then have them restated or have them go through audit checks and whatnot, when you can look at a protocol like Ethereum and see intraday how much it's being used, the fees that it's been generating, what's your yield, your dynamic yield at that very point in time. And you're able to extract a sense of like what's the profitability of the network. I think that's game changing. I'm not expecting it to leak into the equity world, but I think we'll see a world at some point in the future where equities and other assets move on chain, and this will increase visibility overall.
So Jamie, when you're looking at Bitcoin currently trading at, we'll say 29,300 today, and you're looking at your system, are you looking at it as extremely overvalued or slightly undervalued, overvalued rather? And can you give us a price target? Because David's dying to know a price target.
Yeah, I mean, look, there are still obviously some challenges out there, some rather large challenges. Depending on where you sit on the side of the fence of the US recession, what the Fed's been doing, I still think runs the risk of a calamity. But it seems like some of the concerns are starting to abate. More to the point, I think of things in terms of risk reward. So even if Bitcoin was to see a 30, 40, even maybe a 50% pullback in a worst case scenario, you've still got multiples of upside. So think of it as 3 to 4, 5 to 1 sort of ratios. Because I think in this cycle, we'll see a price of 90,000 to 180,000. And that's based on the simplified cycle analysis. So there isn't any inputs into this analysis other than the previous cycles. And looking at the diminishing returns of the asset class, because it's a larger value. So can't grow at the pace that it has, obviously, otherwise it would basically eat all other asset classes. And there are plenty of maxis out there who think it will. But I do think that if you look at just the price returns of the last couple of cycles and take a moderate conservative approach of looking at maybe a 25 to even a 50% of the previous return of the last cycle. So the last cycle returned about 2,000%. So if I'm looking at sort of, a reduction of 75% of that return, I get to roughly $90,000. And if I see doing 50% of the last return, I get to about $180,000. Now, these are the sort of targets that a lot of people come up with that aren't anchored in any fundamentals. So what would active entities need to be if you were to see a price of 180,000? I modeled this yesterday, so don't quote me on it, but I think it's roughly around 650,000 active entities. Active entities need to double to get to 180,000. So when you're listening to price targets from people on Twitter or from anywhere else, and they're spitting out the price target based purely on previous cycles, ask them what they think, some of the fundamental metrics would have to be in order to justify that price, because that's generally what's missing from a lot of forecasting. It's what's missing from what was ultimately missing from Plan B's stock to flow ratio or price targeting model. And so, I put out those they're not a target. We don't actually provide targets. So all financial disclosures, I'm not a financial analyst, financial advisor, all that sort of stuff. But you've got to have the fundamentals back up those price targets. So we've got to see a very strong response globally to adopting the Bitcoin network to get to those levels. But ultimately, I'm a believer that it will, because of the benefits it provides, more so for people outside of our jurisdiction, right? I mean, Bitcoin is money and protection for those that need it most. And that's really emerging markets, the global south, those in totalitarian regimes, and so forth.
Is it like actual growth of that one metric that's like the most critical, or could it also be a change in liquidity from the Fed's balance sheet? And in that, like, what does $1 trillion swing one way or the other due to Bitcoin's price? Like, ballpark.
Yeah, really good point. So on the back of that, if we think about like that first slide where I was looking at secular trends and the macro, and that feeds into the demand for the network or for the asset. Active entities going to 600,000, price going to 180,000 is also predicated on massive liquidity expansion. A Fed balance sheet that goes from 7 to about 12, and the Fed monetizing most of the US debt.
Sorry, 600,000 users or a Fed balance sheet of 12, or 600,000 users and a Fed balance sheet of 12?
Well, those two things are married. So without the liquidity from the Fed, you don't get the adoption of the network, and you don't get the price movement. So thanks for raising it, because again, like the challenge I've had with a lot of forecasting and analysts in the space is that they're not tying it back to the fundamentals. But my thesis is the fundamentals are tied to the macro, to the liquidity cycle. So I'm of the view, and time will tell, that the Fed will have to expand the balance sheet again for a couple of different reasons, whether it's bailing out other economies, helping the domestic banks in the US, which are, you know, at the wall, and also bailing out the US government.
Right, and you're like doing the whole, your Fed balance sheet, you're probably removing reverse repos, the TGA, et cetera, to get your balance sheet number.
Yeah. I mean, they'll have to. They're already trying to drain the reverse repos, so that it doesn't. It's effectively yield curve control. What they're trying to do now by issuing the bills. I mean, so how much of the, well, what's the size of the reverse repo facility currently? It's like 1.8. So that is how much capacity they have to play that game. But the US government, I think, has to issue about 1.8. Is it 1. Sorry, what is the reverse repo is 1.8 trillion. And that's about the amount of issuance the US government has to do in the next 6 months. So they're in a, unfortunately, the US government's in a real bind, and the only way I see it continuing.
I think they can just put it on the Apple credit card. They're already more safe, right? Apple's the official risk-free rate of the world now, so you know.
Yeah. So it's a Fed balance sheet expansion, but also other global central bank.
There's a certain level of irony here that the Fed balance sheet has to expand because, well, it doesn't have any choice. And yet it actually benefits the price of Bitcoin, which is more used in emerging markets as a means to transfer value. I had that right?
Both store of value and medium of exchange.
Sure. Wow. So we're at the top of the hour. Jamie, thanks so much. I hope people will follow you on Twitter. You might say your Twitter handle so everybody knows.
At Jamie Coutts.
And this is quite honestly a bit of a privilege, because you're offering up information that usually a Bloomberg subscriber could only access. So thank you very much. And you're calling in from Sydney, Australia, which I think is super cool. And thank you very much. And Cynthia, I'm glad you're back from Brazil, by the way. I think you're back, right?
Yes, I'm back, and they love Bitcoin down there. So as a guppy, I'm happy to see it, bullish price projections here.
I'm thankful we're 55 minutes in and we have not heard Weisskopf's Australian accent yet. So
You have to give this to me, Dan. I can't leave the call without hearing it.
I don't have one. I don't know what he's talking about. But I didn't know that Cynthia's a guppy.
Barely one, yeah. Learning to swim. Yes.
So next week we've got Jay Coulter coming on the show. Some of you are probably familiar with Jay. He works with financial advisors in various capacities. Jamie, thanks so much for joining us on the show. We really appreciate it, and enjoy your evening.
Yeah, it was a blast. Thanks very much for the invite. Enjoy my day, you mean? Yeah.
Yeah, your day, your morning. I'm sorry. That's right. Thanks everybody.
Thank you so much.
Cheers.
Yeah.
Ciao, ciao.
Bye.